Welcome, everybody, to another episode of the Tech Guys Who Invest podcast. Today, we have Jason DeBono, who's Vice President of NuView Trust, which is a self-directed IRA custodian. And we're going to talk about different plans outside of, a self-directed IRA and solo 401k. So welcome, Jason.
Hey, good to be here. Thanks, Kevin.
Fantastic. So, as I mentioned earlier in the intro, we've heard of self-directed IRAs and solo 401ks, but what are the other accounts that people can use to invest, for their retirement outside of those two?
Yeah, I mean, the world of kind of self-direction, we tend to think of it as a self-directed IRA, therefore it only, means IRAs. And you can self-direct any kind of IRA, traditional, Roth, SEP, or simple. You can self-direct a solo 401k, so a 401k set up with just the business owners. But there's two types of special purpose plans that I absolutely love talking about because they're near and dear to me personally. And that is a health savings account, which allows you to save for health, and an educational savings account, which allows you to save for education, both in a tax advantage manner like an IRA.
Okay. So Jason, for those who may not be familiar, what we're talking about here is being able to invest using those accounts with things other than like mutual funds and stocks and the types of things that people may be familiar with if they have those plans through their employer. Is that right?
Yeah, so when we talk about self-direction, really self-direction and the plan are two different things, right? So if you kind of think about the plan as like the vehicle, right? What kind of car am I going to get into? And the type of plan really is the destination, right? Which is the destination education. If so, then, obviously an educational account makes sense. If your destination is retirement, then you want to look at some that are designed for retirement. And then when it really boils down to the investments, that's really the power, the accelerant that gets you there. And the better you invest, right, the faster the car goes. The idea of investing for most people is stock sponsor mutual funds, because if they've ever set up a 401k or IRA, they tend to get directed to or put into an account that's limited to just those investments. So when we talk about self-direction, it's really the idea of picking your vehicle and then determining what you want as your accelerant to get you to your destination. And if you want that to be stock sponsor mutual funds, then a regular brokerage firm is going to be fine for you. If you want that to be more of the hands-on investments like real estate or promissory notes or private equity, then you want to have it at a third-party custodian or trust company like NuView that's going to allow you the access to those types of investments.
Awesome. We agree with that 100%. We understand that stocks, bonds, mutual funds may be better for some people. That's just what they tolerate, but we love real estate. So that's what we love about self-direction, is you mentioned that you can do just that. So can you break down how an HSA and an ESA actually work?
Yeah, so we'll separate them. They work in general premise the same way, but the process a little bit different. So an HSA is a tax advantage savings vehicle, right? Just like an IRA, but its end game is not for you to save for retirement like an IRA, it's for you to save for your health expenses. Now, before you can even qualify for an HSA, you have to have a high deductible health insurance plan. So if you kind of to step off to the side a little bit and talk about insurance, and I'm not an insurance person, it doesn't matter to me what kind of insurance people choose, but it's relevant for understanding whether or not an HSA is available. So high deductible health insurance is kind of like, think about it like car insurance for a minute, right? If you bump into someone and there's 10 grand worth of damage, right? You're going to go to your insurance, you're going to pay your $500 deductible and move on. But if you bump into someone and it's $300 in damage, well, you have a $500 deductible, right? You're not going to claim that as insurance. You're going to come out of pocket for that. High deductible health insurance is the same concept. So really before high deductible health plans, most people kind of just assumed copay was what insurance was, right? You prepay in your premiums for the right to go to the doctor for little or no cost. Well, they realized that a lot of people aren't going to the doctor. So as a way to drive premiums down, they raise deductibles, just like on a car insurance, right? You can have a $100 car deductible, but who actually does that, right? We want the lower premiums. So with your health insurance, you can put yourself out of pocket up to a certain amount as defined by your plan with a higher deductible. And the benefit of doing so is that you lower your premium. And the goal is that you have a lower premium. You take what you saved, right? And if you don't spend that in your medical bills throughout the year, you've come out ahead. What Congress did to create additional incentive for people to move to high deductible plans and make sure they had money saved to pay their expenses when they did go to the doctor was they created a savings vehicle called an HSA or health savings account. And this plan is actually the best of all plans because in an IRA, you either pay the tax when you take the money out, which is a pre-tax IRA, or you pay when you put the money in, which is the Roth. Both are great plans, but you're paying tax on one end or another.
Right.
In an HSA, you actually get a tax deduction to put the money in. So there's no tax on the way in. In fact, there's a tax incentive. And when you take it out for qualifying medical expenses, it's tax-free. So you're double dipping on tax benefits. There's no other plan where you get the deductibility and tax-free growth. It's usually one or the other. So it's an amazing vehicle if you've made the decision that high deductible health insurance makes sense for you. And that's a decision that you can't make, I can't make for you. Neither can any of us on the podcast today really advise on. It's really a personal scenario based on what's your savings and premium and what's your medical expectations in terms of going to the doctor, and do you have underlying conditions and all of those things. But if you do go the high deductible route, man, that HSA is as great of a plan as you can get to save.
That's awesome.
So with my employer, I have an HSA, and I'm trying to think about how it works here, but if I'm not mistaken, I believe it's just that the money I pay into it goes into more of like a savings account type of a container. And then that's what I'm able to use to pay for those qualified medical plans. With this, what you're talking about with self-direction, it sounds like I would actually be investing with that money instead of it just sitting in a savings account. Is that correct?
Yeah, I mean, the short answer to that is yes, Adam. You're right on in that it's really going today through your employer into a really more of a catch-all vehicle, right?
Mm-hmm.
Set it and forget it type of an account. Whereas if you were to move that account to NuView, it's going to really an actively managed investment account managed by you, not us,
Right.
without limitation to just stocks and bonds. I think the point that's important here is so many people view HSAs really as a spending tool, and it's because that's really how they've been held, and it's what the market has said. So, Adam, as an employee, I mean, you only really know about this plan based on what your employer tells you.
That's right.
So, employer sets it up to, HSA Bank, and the money goes there, and you're told it's there till you need to spend it. And what real wealth building is it's about managing every dollar you have in both a tax efficient and good investment strategy. So, I always tell people building wealth is a byproduct of good tax, opportunities and good investments. And, people make money by making good investments. People get wealthy by making good investments and keeping more of what they make by sheltering taxes. And if you want to be, make money, then don't worry about taxes. If you want to get wealthy, then you got to really start thinking differently. So coming back to your question, Adam, the part that is overlooked is they're viewing that as just a means for you to pay for medical expenses, right? So they take some money out of your paycheck for you, which is nice. They may even add to it on your behalf. We add to our employees' HSAs each year as well. But if you're not putting that money to work, then you're just simply letting it collect dust. And in theory, inflation is actually costing you more on your unspent money.
Right.
What we really practice and preach on the HSA side is two things. Number one, be a saver with your HSA, not a spender. So, one of the misnomers is that it's there to pay your medical bills first. Well, if I go to the doctor, tomorrow and it costs me $200, I don't have to take that out of my HSA. I can pay that $200 personally, but now I have an IOU tax-free from my HSA whenever down the road I want to take it. Well, the longer that I wait to take the money, the more my HSA, if I'm investing it, is growing tax-free for me. So if I can wait 5 years, 10 years, I can withdraw from a much bigger pool of money that's grown like a snowball versus continually depleting this small amount so it never gains enough steam to really grow and be meaningful. So how you use your HSA is one element, how you invest it is another element, and how much you put into it is another element. And the best way to do it is max it out, invest the hell out of it, and don't take any money out of it until you're physically out of money personally and you need it to pay to eat food, right? That's the
Right.
real wealth building strategy.
Wow, that's super interesting. And so I'm definitely learning some things here that I didn't know, which I love. I mean, that's what we love about the podcast. We can learn and teach our listeners at the same time how to think about these things. Like these are the things that wealthy people understand that your average middle class person doesn't, right? You're thinking in a different way because I have to admit, up until about 2 minutes ago, I was thinking the HSA is a savings thing for only for paying, or sorry, the way you said it, like a spending thing, right? Um, so now I'm starting to look at it different. And a question I have as kind of a follow-up is, as I invest in that, what, like, how is the returns on that investment treated as they accrue? Like say I'm making 10% on my money and then that accrues, it goes right back into that account and just continues to grow. And then can I just roll that over year to year without losing it? Can you talk about some of that?
Yeah, great question. Because the latter part of what you said, as far as use it or lose it, unfortunately, as Congress has tried to solve the insurance problem that we have, and I think we'd all agree, no matter what side of the aisle you sit on, our health system, albeit very modernized and it's great, but the insurance side of it is a train wreck. Well, unfortunately, they've created, in my opinion, they've created more confusion than they have opportunity. Because most people think of there's a HSA and then there's a plan called an FSA, a flexible spending account. And they used to refer to them as cafeteria plans. I don't know where the moniker came from, but that's what they used to refer to them as. But it was a way for you to put a little money away, get a little tax benefit, but you had to use it by the end of the year. And I actually, it brings up some funny stories about just the insurance side. I won't digress and get to them, but the idea of use it or lose it is like the worst thing ever, right?
Right.
I mean, think about this. Somebody in Congress had to propose it, and enough people in Congress had to go, that's a really good idea. And it makes you really question, like, what are they really thinking? Because why in the world would you ever want, like myself, for example, I've got, $800 in this account. Why would I just go to the doctor, right? Now I'm taking up a spot and I'm in line ahead of someone that may actually have a real service. And so, it's like, this makes no sense. And I go back to I remember being at the dentist years ago before I was on an HSA program. I was on copay insurance and I thought that was what made the most sense, right? Till someone shared with me the benefit. But I remember it was the end of the year. I'd just gotten a cleaning and the dentist had said, or, one of the people at the front desk said, hey, your insurance program has like $1,200 more of spendable money. Did you want to schedule something before the end of the year? And I'm thinking, yeah, let's go root canal,
Right.
what else, anything that, there's so much satisfaction I get from you drilling in my mouth. This sounds great. But I realized I prepaid for the right to spend that $1,200. And what I love about an HSA is it's the opposite. It allows preventative care because I do believe that's important, but I'm incentivized not to go to the doctor with the sniffles. And let's face it, how many people do you know, right, that they sneeze and they're like, nah, I'm going to go get a Z-Pack, and it's like,
Right.
so now you're going in, you're running the risk of infecting other people. And this is all pre-COVID stuff. It's even heightened with COVID. But yeah, the whole model of it is it trains people to think that the savings side is really not savings. And that FSA use it or lose it model is not what an HSA is. You can keep it forever. It's your account. And you can add money to it every year that you have a high deductible health plan. So if you, for some reason, swap out of it, you don't lose the money. You just can't put more money in. And it's pretty darn liberal in terms of what it can be used for, as far as qualifying for tax-free distributions. I mean, all the way down to massages, if your doctor, believes that that's preventative for arthritis or back pain. I mean, it's pretty darn liberal, which is great. Makes the plan more attractive.
Wow.
That's good to know.
Yeah.
Very good to know. And you mentioned earlier, I wanted to touch on this. Who would determine whether or not an expense is a qualified medical expense?
There's a list. If you just Google HSA qualifying medical expenses, there's a section of code that'll get you there. I've read through it. I think when you get there, you'll be pretty darn surprised at almost everything is. And it's the honor system. And I don't say that to suggest you can pull one over on the IRS, but they don't even make it terribly difficult
Right.
if you do take money out to just report that it was a qualified withdrawal. And the real onus is you don't even have to provide your tax professional receipts. You want to keep them in case they come ask, but you don't need, there's no like submittal level or it's the honor system until you're asked.
Gotcha. Okay, that helps us understand a lot about the HSA, and it sounds like almost a no-brainer if you have that high deductible. But from an ESA perspective, how does that work? Is it similar? We'd love to learn more about that.
Yeah, so the ESA is similar in some ways, but it's very different because in an HSA, there's a qualification barrier that you have to meet to get to it, right? You can't just have an HSA unless you have high deductible health insurance. They go one in hand in hand. An ESA, you have to, it has to involve a minor. And technically, I believe it's under the age of 35, but there's some dependency requirements if they're over 18, right? But if, for the sake of discussion, you just have to have somebody that owns the beneficial interest in the account that's a minor. So, like, for example, you guys could contribute to my kids' ESAs. And I'm happy to get you the information if you feel so inclined to do it. But it's what makes them pretty cool plans. So as long as it just can only be tied to one individual child or grandchild or whomever at a time.
Okay. All right. So with the ESA, could you actually, I kind of have this question for both the HSA or the ESA. Could you combine that with other accounts similar to invest in something? Like, here's a scenario. Let's say I wanted to lend $20,000 to an investor. So it would be like a note. And I had 10,000 in my HSA and I had 10,000 in one of my children's ESA. Could they both sort of work together to do that? Or is that sort of beyond the scope of what you're allowed to do with that type of thing?
Yeah, so I love that question. I mentioned it's near and dear to my heart. It's exactly what I do with my accounts. I have an HSA, I have an ESA for our 9-year-old, and I have a Roth IRA and a 401k that I self-direct, right? They all have differing amounts of money in it. Almost everything that I've ever done has been with at least 2, if not all 4 of those accounts. So your example of taking 20 grand, that's such a real world example. I may take 10 out of my 401k, 4 out of my son's ESA and 6 out of my HSA. And whatever the prorated dollar amount we invested in, it defines the percentage of ownership of that investment, whether it's a note or real estate, it doesn't matter. And then each account is the benefactor, right, of the performance of that percentage of the asset.
Nice.
Yeah, it's a great, that's what makes these plans so attractive is the ability to invest them right alongside bigger accounts, because let's face it, I mean, no one's starting an HSA and putting 100 grand in there, but right. A few grand each year added up can become significant money over time.
So it ties back to that point that you said earlier where you were talking about you combine the tax benefit strategy, you don't spend the money. All of it it's in the underlying theme is the intentional spending of the money or intentional investing of it, putting it away for a specific purpose. With the HSA or the ESA, you can invest it. And of course, they have an end goal in mind, but still, to your point, you can grow the HSA to however large you want. So
yeah, I mean, that's the value of any money that you have. I mean, I love what you guys do, and I love your podcast because it talks about investing, and you guys are active employees, but you're not throwing your hands in the air saying, I have to work forever and trade my labor hours for dollars, and that's how I make money. That's part of it, right? We all have to start somewhere, but every excess dollar that you save, right, from what you earn, you're investing. And we're not here, as NuView to tell you not to do that. We're here to simply say, if that number for you guys is say 10 grand a year, right, of excess money that you want to go put to work, my approach is before you put the 10 grand into an investment, ask yourself first, is there a vehicle I can tuck it into first that makes the investment a better return? So, Adam used the example of a 10% loan, right? Real world example. Loans exist like that all day long.
Yeah.
So if you had that money, right, that 20 grand that you earn more through your W-2 employment that you wanted to invest, today, most people would just take the 20 grand and go buy the note, and they think they're doing really well. And candidly, you are doing really well. I'm not telling you you're doing bad. But if you took that 20 grand and you put 3,500 and maxed out your HSA, and you put 2 grand in each of your kids' ESAs, right? You took 5 grand and added to your Roth IRA, and then you took that sum of 20 grand and bought that note, you just guaranteed that all 10% that you make is going to compound for the life of each of those accounts, as opposed to taking that 10% and letting Uncle Sam grab a piece of it. Less to reinvest, less that you'll gain over time. So, investment accounts are not investments. They're just vehicles, right, that make your investments more efficient.
I love it.
Me too.
Yeah,
I
this
love the
is
idea it's a vehicle.
fantastic. Yeah, me too. So, Jason, what about some limitations on the HSA and the ESA? Are there limitations around that that people should know about when they're considering starting one of these?
Yeah, like any tax advantaged account, there's a fence, right? They're not open ended for good reason, probably. Let's start with the HSA. So we already talked about the first limitation, which is you have to have high deductible health insurance. Once you meet that criteria, you can contribute, and don't quote me on the exact numbers. I know for 2019 it was 3,500. I think for 2020 it's 3,550 for an individual, and it doubles if you're on a family high deductible insurance plan. And the beauty is you actually don't have to be on the same plan with your family. So, for example, I actually have my own individual HSA plan, and my wife and kids have a separate plan because their insurance needs are different than mine. So there's some strategy there. I share that just so you guys understand from an HSA standpoint. If one of you in the family loves it, but maybe a spouse or kids, you really don't want to be on a high deductible, you can split that off. The limit is 3,500 or 3,550, and it doubles for family. An ESA has a straight 2,000. Sorry, let me go back. It's a full tax benefit for that. There's no income limit on the tax benefit, which is great, depending on where your earnings are. And there's no income limit on your contribution. So it's like the best deduction you can get because it's guaranteed. On the ESA side, it's a $2,000 contribution limit. There is no tax benefit. And I'm sorry, it's $2,000 per beneficiary or recipient. So, I have 2 kids, I can have $2,000 in each ESA, right? The contribution is non-deductible to whomever makes it, so there's no tax benefit, and the contributions can come from anyone. So, for example, like take my son, in his account, we take all the money that people give him, birthdays or Christmas, and we just put it right in his HSA or into his ESA. And then at the end of the year, whatever hasn't been contributed, we put in the rest. And then there's an income limit, and it's pretty low compared to most income limits. So a lot of people will get tripped up with this, but it's an easy way to get around it. So there's an income limit to add money to an ESA. However, you can gift that money to grandma, and grandma can make the contribution to their ESA. So it's just a step. It's not a deterrent, but that's per recipient. So if you have 2 kids and 2 grandkids and you want to contribute, you can put 2 grand in each of theirs, as long as you as the contributor are not over that income limit.
So could you start an ESA for, let's say you have a niece or a nephew, could you start it for them, or does it have to be the parents of that child?
No, I mean, that's the beauty. You can start it for anyone, and you can contribute for anyone. One other thing that's really, really cool to note, depending on whether you have kids or use the example niece and nephew, always max out the oldest sibling first, because if they don't use all the money, the sibling can roll it to the next sibling.
Whoa. Explain that again. Okay, so
So I'll give you a real world example. So I have 2 kids. Right. And actually, my example is a very good one because I have a big gap between them. I have a 9-year-old and I have a 10-month-old. So from an ESA standpoint, if this year we said, hey, we only have 2 grand total, right? I'm better off putting the 2 grand in the oldest child's account first, because whatever amount is not used can roll over to the youngest child.
Like they get a scholarship. You don't need as
You got
much.
it.
You can roll it.
Yeah, and the
Nice.
other thing about ESAs that's really cool, and you mentioned scholarship, Adam, that's really cool is it doesn't have to be used for post-secondary education. So when you look at alternatives like 529 programs and college prepay, those are truly post-secondary education. If you set this up in an ESA, so going back to scholarship, so if your son is a great golfer, for example, and going to a private school that's got a golf academy tied to it, it's going to increase the odds of getting a golf scholarship. Well, that ESA could pay for that high school, right? Education, private education, tax-free. And you're spending the money really as an investment. You're really taking investment money and making an investment in a scholarship through that school. So there's a lot of opportunities that it does. It opens a lot of doors.
Nice.
That's awesome. That's really cool. So we talked about the fact that it's a vehicle, right? So what are the things that you can take that vehicle, what directions, I guess, can you take that vehicle in when it comes to these accounts? Are there limitations to what you can and can't invest in?
So every type of account and account and investments are two separate decisions, and they're not one-to-one, right? It's not one account, one investment. It could be 10 accounts. So I preface with that because I want to remind everybody here is you should be thinking about every opportunity to take advantage of these tax advantaged accounts. So kind of like I used Adam's example where he's got 20 grand of money. If Adam only thought of this as a one and done, he may only put 5 grand into a Roth IRA. And he may keep the other 15 grand in a taxable account, which may not be the best thing for him. Whereas knowing that there's an ESA and an HSA and whatever it is, he's able to get maybe that 5 to 10 or whatever. From a limitation standpoint, once the money's in the account, whether it's an HSA, an ESA, a solo IRA, or solo 401k or QRP, whether it's in a Roth IRA traditional, once it's in there, the rules are universal. You can invest it into anything that is not a life insurance or collectible. And you can invest it with anyone with the exception of you and your spouse, your parents and your grandparents, your children and grandchildren, and the spouses and businesses of those parties. And because of the tax benefits, the IRS knows that, like, if my dad could loan me his IRA, right, it would behoove my dad to loan it at a really good discount, right, to get money out of the IRA without paying tax, or at a premium whereby I could sock a bunch of money, right, and pass it to him tax-free. So the IRS says you just can't do it. So all transactions have to be at an arm's length and cannot include most of those kind of closely held family members. Beyond that, there are no limitations to what you can do, so long as you're operating within basic boundaries of market rates if the IRS were to question it.
So you couldn't do like a note and charge, I don't know, 115% kind of thing? Like it has to be reasonable is what you're saying?
It has to be defendable. And I say that because it puts people under the mindset of this is your problem to defend, not mine, right? So I can't tell you what's reasonable. It's up to you. And so when you go through the process of making your investments, yeah, you should always look back and say, I use this simple litmus test. If you were doing the deal and I was on the other end of it, instead of whomever you're making the deal with today, would the terms be the same? So, right, if Kevin, if you called me and said, hey, I'm writing a loan at 150% interest, rates. Okay, great. If I were on the other end of that loan, instead of whomever is, would the terms be the same? Or would you be like, well, it's kind of like my buddy, or, well, it's kind of, if you're answering it with, well, or let me tell you, then it's not arm's length, right?
Right.
Does it mean you'd write me a loan at the same interest rate you'd write Adam? Of course not, right? Maybe your knowledge of Adam and his business and understanding of his being a good saver and a good steward of money, yeah, maybe you'd write him a loan at 8%, right? Whereas me, you'd write it at 10 because there's some unknown. So it doesn't mean everything has to look identical, but it means that your spread between the deal with me and the deal with someone you know shouldn't look so inherently different that it's painfully obvious that it's a sweetheart deal, because that's what the IRS is trying to prevent. They don't want you doing sweetheart deals because the tax benefits are so darn good. So it's a reasonable reason for them to want to police it, right?
Yeah, it makes sense. That's a good explanation. Good way to put it in terms that anybody can understand there. So Jason, as a W-2 worker, let's say I wanted to move my HSA to uh, one of these self-directed types through NuView. What does that process look like? And, what kind of happens to my existing account and that money, and how does all that work?
Yeah, so the HSA is portable, right? Meaning you have the right to move it anywhere that you want. Your employer cannot mandate that you use ABC Bank as your, custodian. The thing that they can control is whether or not they'll run payroll deduction to 1,000 different firms. So they may say the only payroll deduction we do, and the default is this, ABC Bank. So what it would mean is that they would no longer run payroll deduction. You would have to manage your own payroll deduction or write your own check. Now, what we have seen people do is, so maybe you've got $3,000 in your HSA today. We've seen people transfer the $3,000 to NuView, set up a self-directed account, and then they still keep their existing account to be the repository of the payroll deduction and put it all in the account. And then every quarter or every month, every 6 months, they transfer the cash, because you can have two HSAs, you just can't contribute beyond the limit.
Ah, okay.
So you have some options. I always recommend starting if you're making your own contributions to the HSA, well, then just change the check you write from whoever it is today to NuView. That's easy. If your employer is facilitating it, then I would always suggest call your HR and just ask them, like, hey, I want to hold my HSA at a different place. Can you guys facilitate that? And I think you'd be surprised how many times they'll say, sure, just give us the information and we'll do it the same way. They just default because that's what big companies and most employers do, right? They default back to the easiest option, maybe not the best.
Makes sense.
Yeah, that makes sense a lot. Well, Jason, we wouldn't be the tech guys who invest if we didn't ask you a tech question.
Oh boy.
And as we're recording this, it's towards the end of September 2020. We all know that we've experienced the pandemic, working from home. What has been the saving grace as far as technology for you during this whole time?
Let me ask one question. Is that personal or professionally, or either or both?
Either or both.
Gosh, tech has done so much for us all. I think Zoom, it's such a easy answer, and I hate to give that one, but I think Zoom has made has had profound impact, because it's really allowed us to personalize what COVID depersonalized, as best as you can. And I think I speak for a lot of people when I say it's actually caused me to go, man, I feel equally as connected, right, with the two of you via Zoom, as I would have possibly if we were in the same room. And it's not identical, but I feel that. And if we were on a phone call, we wouldn't have near that level of experience, or at least I wouldn't have that level of experience, because for someone that does a lot of presentations and to me, if I can't see someone, I have no idea whether or not anything I'm saying is resonating, and I can't, slow down or speed up or move topics without it. So I will default to probably the most basic answer there, which is Zoom.
There was this little joke at the beginning of COVID that we think Zoom may have started this whole thing. Obviously, we know it's not Zoom, but I know that they did really well, and they're continuing to grow because of everybody's been forced to work remotely.
Yeah,
Well, I
absolutely.
give Zoom so much credit, and I'm not I know enough about tech to know that as demand increases, there's challenges. I mean, look how many websites crash. I mean, hell, the stock exchange has crashed on certain, based on certain number of activities. And I think to myself, man, Zoom has like 10x their user base, and I have never once had a problem, ever.
Wow.
And think about any other tech platform. I mean, if Facebook had 10 times more people log on tomorrow, something's going to suffer as a result, or whatever it is. So I think Zoom deserves every bit of growth and accolade they get, because they have managed this process so effectively. It's been really, candidly, very impressive for me to watch.
Agreed.
Yeah, the tool itself has risen above other similar tools during this, which is also interesting to me. So, well,
Yep.
Jason, listen, it's been awesome having you on. I think you've added a ton of value to our listeners, so we're really grateful to you for that. So, where could people go to learn more about taking control of their retirement with NuView Trust?
Um, well, thank you for having me. I enjoyed it equally as much. NuViewTrust.com is by far the best place. It's NuView with a U, NuView Trust.com. There's a section there of all kinds of content, educational content, live and pre-recorded content. So I'm a big believer in education, and we only know what we know, and we're going to be most successful in life by realizing what we don't know, and being open to learn that. And we've had a lot of really smart people over the years that have been, kind enough to share some content with us, as well as some of the content we produce on self-directed accounts. So start there, and all of our contact info is on the website. If you want to reach us or contact us more deliberately, you can certainly do that.
Awesome. Well, thank you
Excellent.
so much, Jason. We will put all that in the show notes. If you have any questions about any self-direction, don't hesitate to reach out to anybody at NuView Trust.
Great. Thanks, guys.